If you look at house prices recently, they've been surging upwards, and it's looking very much like we're in a housing market bubble. So in this video, we're going to look at the reasons behind that growth, but also try to look forwards and try to put some numbers around where we could be headed. And we use a very simple model based on price to income ratios and income growth. And we'll do this for the UK, and we'll do it for the US with chapters so that you can move between the two. So let's look at the housing market bubble in a bit more detail. If we look at house price drivers, one of the most important ones is the level of interest rates. When they tend to be low, then we see house prices pushed upwards because people can borrow more cheaply and many people buy with a mortgage. Another factor would be a rising population, and that could be because there are more people or because we have smaller households, which has been the case recently. Another big driver would be wage growth, again, because mortgages are usually a multiple of your income. If we look at negative factors, then we'd look at things like supply. If there are more houses being built, then that would tend to push down prices overall, assuming that demand remains the same. Another factor would be high inflation, because this tends to take money out of our pockets and give us less disposable income, which is used for that earnings multiple. And then finally, if house prices are high relative to income, that tends to depress their growth over the next several years. So we'll be looking at these factors as we go through this video. Now, if we look at which of those drivers has changed most recently, it's rapidly rising interest rates. The primary reason behind rising interest rates has been high inflation. As we move away from the pandemic recessions that we saw, we no longer need the stimulus that we had before. We're also seeing very high inflation across much of the developed world, so central banks are now seeing a necessity of raising interest rates, and that pushes up all interest rates, including our borrowing rates for our own mortgages. Now, during much of this period since 2009, after the financial crisis, rates have been almost at their zero lower bound. So for many people, it'll be a shock if we move back to where we were in the past. So to see that, let's zoom out on the graph back to 1980. The last time inflation was this high was the end of the Volcker period, when Paul Volcker was head of the Federal Reserve. And when that was the case, policy rates in the UK were over 10% and policy rates in the US were at around 7%. Now, I'm not saying we're going that high again, but it's certainly not going to be the case that we're at the zero lower bound in the years ahead. We've just got to get used to the idea that interest rates will be higher. And that's already affecting interest rates in the US. So this is the 30-year fixed borrowing rate in the United States, the average one, and that's increased very rapidly recently. It's gone up to 5%. But notice that it was at historic lows only a few months previously. Now, compared to the Volcker era in the late 80s, the actual interest rate still remains pretty low, but what's really shocking is the rate at which it's increasing. So for example, if we look at the 90-day change in that 30-year fixed rate, you can see at the moment it's rising very rapidly. In fact, the last time it rose this rapidly, which you can see easily with the dashed red line, was actually at the end of the Volcker period. So certainly if you're thinking of getting a mortgage right now in the United States, or in Europe, where we don't have fixed 30-year mortgages, we usually fix for a couple of years, and then we go to a floating rate or we fix again, then you've got to be thinking, well, I can't borrow so cheaply now, so I won't be able to afford such an expensive house. Also, banks will be willing to lend less if they think the debt servicing costs will be higher. So that'll have a chilling effect on house prices. And because we can only borrow against our income, if incomes fall, then that reduces the amount we can borrow. So what really constrains house prices over the long term is the rate of real wage growth. Once you adjust for inflation, how much more are you taking home in your salary every year? Here we can see that rate of growth in blue for the UK, and we can see the rate of inflation in red. Now, wage growth was actually less than inflation for many years after the global financial crisis for the UK. We finally saw that change around 2015 when it did go positive for a while, then it dipped again, went positive for a while, and during the pandemic it went negative and then positive again. But recently we've seen a surge in inflation, and really that's just the beginning of that surge for the UK. Many people expect that will go as high as 8%. And if we look at real wage growth, that's actually fallen to zero. So that's definitely a negative for the UK housing market. And I think it's very unlikely that UK wages will keep up with, say, 8% inflation. If we look at similar data for the United States, here real wage growth is shown in blue and the US inflation rate is shown in red. What's kind of interesting is that during that Volcker period, when inflation was very high, you can see it reached almost 15% in 1980. What's remarkable is that wages were actually keeping up with inflation. They did dip into negative territory briefly, but wage growth was pretty brisk at that time. Unfortunately, recently, that hasn't been the case. So US inflation has gone above 8%, and we're seeing negative real wage growth. So all we can really hope is that inflation falls and wage growth becomes positive in real terms. Because until that happens, this is going to be a drag on the US housing market, but also for European housing and housing in the UK. Now, before we get onto the forecast, let me just quickly tell you about our membership, which is a great way to learn about investing and support us. And you also get to vote on members-only content, which only you get to see, and you get to join us on Slack and ask a question anytime you like. Now, to learn more about that, just click on the link beside me or look in the description beneath me, and we're now running that on our website, which is PensionCraft.com. Now let's look at the UK housing market. The data you can see here is a nationwide house price index, and it's updated quarterly. What's good about this series is that it goes back a long time, back to 1950 in fact. So the top panel that you can see here in blue shows you the actual average house price. And then the bottom panel is a year-on-year change in that price. So these periods of huge price increases were in the 70s and early 80s. Then you can see the very rare periods when we had falling house prices. So that happened in the early 90s, and it happened again during the global financial crisis. And if we look at the recent period, you can see the acceleration in house price growth that we've seen since the pandemic. Now, if we switch to monthly data, we're going to have less history. We'll only go back as far as 1990, but we'll see more recent changes. So here is that monthly data, and you can see in more detail that acceleration that we've seen recently. It really does show no sign of abating yet. The latest nationwide report is actually an interesting one. So here is that acceleration in house prices that we just saw. But what's great about the report is that it drills down into the reasons behind the acceleration. Now, one of the reasons is that during the pandemic, we spent less and we saved more. If you're not going out, you can put money towards a deposit. And what we've actually seen is that the rate of deposit growth for houses has actually gone way above its long-term trend. And on average, households have put aside about £6,000, which they've put into their deposits, more than they have in the past. Now, in turn, that means you can pay for a more expensive house, because if you've got a larger deposit, your mortgage will get you to a higher price. So having more savings has certainly pushed up prices. At the same time, what's going to have a negative effect on the market over the next 5 years, 10 years say, is the fact that affordability is much weaker. We'd usually measure that by comparing the price of a house and dividing it by the earnings of the household. Now, just before the global financial crisis, that multiple was around 6.5 times. But currently you can see we've surged past that, and we're almost at 7 times the average earnings. Now that in turn means it's less likely we're going to surge much higher unless earnings growth recovers. But as we've already seen, real earnings growth in the UK has actually gone to almost zero. So the only way prices can go higher from here is for this price to earnings ratio to increase. And remember, this is a mean reverting number. So the tendency is actually going to push it in the opposite direction. Now, as usual in the UK, there's a massive difference between London and the rest of the country. And in this case, London prices have actually been growing much more slowly than the rest of the country. And I suspect valuation is behind that, because valuations as a multiple of earnings are much higher in London than they are in the rest of the country. In fact, the greatest growth in prices that we've seen over the last year has been in Wales. Of course, another driver of the housing market in the UK has been more people being able to work from home. If you can move out of London, say into the outer metropolitan region, prices there tend to be much lower than they would be in the capital. And the further you move out, the greater the savings in terms of your housing. Now let's look at the UK forecast. Now the way this forecast works is very simple. It just has two numbers. The first one is the average income. So we simply extrapolate that based on the trends in the past. And what we do is we have a central case, that's the red line, and we have a worst case, which is the blue line, and a best case, which is also blue line, which is above the trend. And then in the bottom panel, you can see here, we've got the historic price to income ratio for the UK, and we also extrapolate that. Remember, this one is mean reverting. It tends to go back to the long-term average. So in the central case, which is the red line here, it's actually moving back to that long-term average very gradually. And then in the best case, it actually doesn't mean revert at all. It's a bit of a YOLO scenario in which we ignore valuation altogether and it carries on increasing. And then in the worst case, the pessimistic case, if you like, we get very rapid mean reversion. So to come up with our forecast, we just multiply those numbers together. The price to income ratio is just multiplied by the income that we forecast. And if we do that, it's certainly not catastrophic in the central case. It just has very slow growth over the next 3 years. The best case, the kind of YOLO case where we ignore valuation altogether, earnings growth is really good, then we get about 7% growth per year over the next 3 years. And in the worst case, remember we got the rapid reversion of the price to income ratio, and we got fairly low wage growth compared to trend. So in that case, you get a 6% fall in house prices every year for the next 3 years. So I think I'm not particularly optimistic about UK house prices over the next 3 years. The central case is sensible, I think, which is an almost flat market. It really depends on how high inflation goes. I think that could be the ultimate driver of a leg downwards for UK house prices. Also, if we get a recession in the UK, banks are less likely to lend. They'll be much more strict about their lending criteria, and that will also have a chilling effect on the housing market. Now for the UK, Nationwide actually produces a regional breakdown of earnings numbers, but also house prices. These are the regions you can see on the left-hand axis here. The one which isn't very legible is Yorkshire and Humberside, and Outer Met is the region around London. But what their numbers let me do is to produce that forecast for every region. And I've only shown you the central case here. I haven't shown you the kind of upside and downside cases. But what is kind of interesting is that London's forecast to have the greatest growth. Now, the reasons behind that are the wage growth for London tends to be very brisk, higher than the rest of the UK, and the model assumes that will continue. Also, the price to income ratio in London tends to trend upwards and not be very rapidly mean reverting. So that combination, if we assume the central case, is actually very positive for London, but also for Scotland, the outer metropolitan region, and the north. The region which is the worst by a long way is Northern Ireland. And the reason behind that is that the price to income ratio there tends not to trend upwards, although it has recently. So the model's kind of assuming it's going to revert to trend very rapidly. But with all these forecasts, remember the error bars are absolutely huge. So I wouldn't put too much faith into any of these numbers at all. Let's look at the USA now. And this is the Case-Shiller Index, which is the average US house price going back to before 1990. The top panel is the average price, and the bottom panel is the year-on-year growth in that price. So there was also a dip, as there was in the UK, in the early 90s. Then there was a big dip, which was fairly long-lasting during the global financial crisis. And here is a very rapid recent acceleration in US house price growth. Now, if we look at the average house price growth, but broken down by major cities, on average, you can see that urban growth in house prices has been around 5%. That's the kind of average of averages. The worst growth was in Chicago since 2000, that's 2.6% per year, and the highest was in Los Angeles at 6.3%. So remember that, and now we'll look at the most recent changes. You can see these are way above the long-term growth rates. So for example, Phoenix is up by 33% from January 2021 to January 2022. If we compare that with Phoenix's long-term average growth since 2000, you can see that it's around 7 times that average, which is only 5%. In fact, even for the worst growth over the last year, you can see that's 12%. That's also a multiple of its historic average. So while there have been real hotspots for growth over the last year, on average, you can see that this euphoria in the housing market has pretty much been a universal phenomenon. Now, if this is a bubble, then it has to at some point pop. And one reason why that may not happen soon is because the actual debt servicing costs in the US still remain very low. Here you can see the mortgage payments in a household divided by personal income. That actually peaked in 2007, just before the financial crisis, at just over 7% of income. But notice that because interest rates have been so low for so long, that debt servicing costs rapidly decreased. And currently, it's the lowest it's been for about 40 years. Of course, as interest rates increase, then that could increase debt servicing costs in future. But for people who've bought a house, who are going to stay in that house for 30 years at their fixed mortgage rate, well, it really isn't a problem that house prices are increasing. Another nice point made here by Jessica Nutt in a tweet is about the number of people who are putting a large deposit down on their property, or maybe buying outright in cash. So this shows you the market share, think of that as the equity in the house, on average per home purchase. Now that's been creeping up since 2000, and recently it's surged upwards to 18%. Now that's important because even if interest rates increase, if you have a larger deposit or if you're a whole cash buyer, then you won't care about interest rates. So these would be rate insensitive buyers, and that's an increasing proportion of the US housing market. And that in turn means that even if the Fed hikes a lot, it won't matter to these buyers. And one reason why people have more cash is because they were spending less during the pandemic. If you're locked up at home, you can't go out for meals or to the cinema or movies, as you call them in the US. And that meant that the personal saving as a percentage of disposable income surged to levels we'd never seen in the past. It was well over 30% for a very brief period of time. We also got the stimmy checks in the United States, which in many cases may go towards a house deposit. Now, of course, that'll be a temporary factor. Eventually that money will be spent. And in fact, that's exactly what we're seeing. The savings rate has fallen to levels which are actually lower than they were before the pandemic. Now, another one of the factors we discussed at the beginning of the video is supply. And in the US, we have housing starts. These are the number of new houses which are being added to the pool of houses in the US, and it's measured in thousands of units. Notice the huge chilling effect of the financial crisis, which actually limited supply for a long period of time. But certainly for the last several years, that's been increasing, and despite the hiccup due to high lumber prices that we saw briefly, it's also been accelerating since the pandemic. So certainly US supply is accelerating. And over time, what we'd expect is that this gradual increase in supply will reduce the rate of house price increases. Now let's put some numbers behind that with a USA forecast. So in this top panel, you can see the average US income, and that's been gradually increasing over time. And then we extrapolate that with the central case in red and an upside case and a downside case in blue. And then here in the bottom panel, we look at the price to income ratio in the US, which remember is mean reverting. In the central case, the mean reversion is slow. In the optimistic case, it's a very rapid increase in price to income ratio where we kind of ignore valuation and throw caution to the wind. And then in the downside case for the price to income ratio, we get a very rapid mean reversion. So to produce a house price forecast, we just multiply our hourly income by our price to income ratio. And for the US, our central case is 3% year-on-year growth in house prices over the next 3 years. Now, the best case that you can see at the top is for 9% annual growth, and that's assuming steady wage growth, which is very high compared to trend, at the same time as you have price to income ratios surging upwards. The downside scenario assumes a very rapid mean reversion of the price to income ratio combined with fairly lackluster wage growth, and that'll give us a minus 3.5% growth in house prices every year. So for the US at least, notice that this is asymmetric. The upside looks bigger than the downside, which is certainly a positive outlook, I think. So there we have it. That's our forecast. For the UK, we expect a flat housing market. That's our central case. And then for the US, we'd expect slow growth of about 3% per year due to the very high valuations that we're seeing right now. It really depends what happens to wage growth, which in turn depends on whether we get a recession. So if we do get a recession, usually what happens, banks tighten up on credit, and that means that there's a big chilling effect on the housing market. And certainly banks in the UK are already saying that that's what they're planning to do, to make it tougher to get a mortgage. So if that does pan out, then things could be a lot worse. Now, we actually talked about this very topic in our podcast, Many Happy Returns. You can find that on your podcast player. And don't forget our offer for Patreon. You can join our membership and learn more about investing that way. And as always, thank you for listening.